Welcome to part one of Separating Myths from Truth, the Story of Investing. Again, what we're going to cover in this video series is the myths of investing. We're going to dispel the traditional investing myths, and then I'm going to tell the true story of investing, and at the very end you're going to have the opportunity to achieve true peace of mind. So let's get right into it, and let's look at the definition of a myth. A myth is a story made up to explain a phenomenon that is beyond the science of the day. For example, in ancient Rome, hundreds of years ago, everybody in the world basically believed that the earth was the center of the universe and the sun revolved around the earth. It wasn't until Copernicus and Galileo used prisms and mirrors and math and science to determine that actually the sun was the center of the universe. Now, this information, this new discovery, was not taken very well from the people of the day. As a matter of fact, Galileo spent the rest of his life on house arrest because of his discovery. So what traditional investment myths do we believe in, and does the entire industry, the brokerage firms, the mutual fund companies, and the insurance companies teach us that are true? First, we're going to look at stock selection or stock picking. This would be a question if somebody asked me what stocks or companies I like now. The second myth is track record investing, or which managers do I like. The third myth would be market timing, or should I be in or out of the market. And the fourth myth is one that most people don't want to talk about, and that's the cost of investing, or the hidden cost of investing. So let's get right into part one and talk about the first myth, stock selection. Stock selection can be defined as choosing stocks based on a belief that they will do well in the future, beat other stocks, or beat the market. The myth is that investment advisors can consistently and predictably add value by exercising superior skill in individual stock selection. So let's put math and science and academic research to the test to see if this traditional investing belief is actually true. The first thing we're going to look at is a list of the entire universe of mutual funds that's ever been created since 1923. One thing that we noticed when we bought this list from the Center for Research and Securities Pricing from the University of Chicago, that in 2010 the total number of funds that were available or open that year was over 27,000. That's 3 times more stocks than there are on the U.S. market. Since 1923, the total number of mutual funds that were born was over 46,000. So if we do a little simple math, we realize that there were over 18,000 mutual funds that were actually killed off. The question is, what happened to these returns from those mutual funds? Did they get swept under the rug? This is a list of the 200 worst dead mutual funds, and this is their average return, negative 77.7%. Now, I don't think any of us has ever seen an advertisement for a mutual fund that purported they did negative 40% returns in a year. And there's a reason why, because they took those mutual funds and they merged them with better performing funds. So what happens if we take all this data, all the return data from the dead mutual funds, and enter it in with the ones that are still alive? We did this with a equity portfolio of mutual funds, of stock picking mutual fund managers. Now, we went back to 1973 for a couple different reasons. One primary reason is we have international and bond data back in 1973, but also that in 1973 and 1974 we had double-digit negative returns in the stock market. So let's see how the average stock picking mutual fund did for that period from 1973 to 2010. $100,000 invested with the average stock-picking equity-based mutual fund grew to $2.1 million. Now, if you compare that to just the S&P 500 index, the market itself, the 500 largest companies available in the United States, and you took the same $100,000 and stayed disciplined since 1973 and stayed invested, your $100,000 grew to $3.5 million. This is the actual wealth lost to active stock picking, $1.5 million, and that's on a $100,000 investment. Obviously, if you have $500,000 to invest, that's over $5 million of wealth lost to active stock picking. $1 million to invest, that's over $10 million lost to active stock picking. Now, on the previous slide, we just compared the average of the equity-based mutual fund. On this slide, we have added in the international and the bond data, and we've compared it to 4 hypothetical portfolios based on risk-return characteristics. And what we found is, if you start from the same 1973 period and invested that $100,000, the average of all mutual funds grew to $1.2 million. If you take a very conservative portfolio, one that has 75% fixed and 25% equities, a matter of fact, a 95-year-old could handle the risk in this portfolio, you can see that the conservative portfolio with $100,000 invested grew to a little over $3 million. If you put it in a moderate portfolio of 50% fixed and 50% equities and diversify it properly and stay disciplined, it grew to over $5 million. The next line up, a more growth-oriented portfolio with 75% equities and 25% fixed, it grew to over $8 million. In the very top line, at a 100% equity-based portfolio, grew to over $10 million. So you can see the actual wealth that is lost to stock picking and choosing managers that pick stocks. Now, I know what most people are going to say at this point. I'm not going to pick an average mutual fund manager. I'm going to pick an above average manager. So how would we go about determining which is above average manager, which is the manager that will outperform the market in our opinion? We're probably going to look at a history or a track record or their past performance. This leads us to the second myth, which is in video number 2, track record investing.